You're doing everything right, you make decent money, you pay your bills on time, and you've decided that paying off your mortgage early is the responsible thing to do. The American dream, right? Own your home outright, sleep peacefully knowing you owe nothing to anyone. But here's what nobody tells you. That decision might be slowly bankrupting you, not in the way you think. Your credit score isn't tanking. You're not spending money you don't have. But mathematically, financially, in ways that compound over decades, you're getting weaker while you think you're getting stronger. This isn't about being irresponsible with debt. This is about understanding how the system actually works. And once you see it, you can't unsee it. The worst part, you've been taught this is virtuous. Let's start with the story you've been told. Debt is bad, debt is dangerous, debt is a chain around your neck. And technically, that's true. Carrying credit card debt at 23% interest is catastrophic. A personal loan for a vacation is indefensible, but a mortgage is different, and the reason why requires us to go back about 70 years. After World War II, the American government made a deliberate choice. They wanted to build suburbs. They wanted to encourage homeownership. They wanted to move people out of dense urban centers and into single-family homes with yards and picket fences. So they did something revolutionary. They created the 30-year fixed-rate mortgage and made it tax-deductible. Think about what that means. The government literally pays you to borrow money for a house. Your interest payments come off your taxes. It's a subsidy, an invisible transfer of wealth from federal coffers directly into your pocket if you're willing to take on debt. For most of the last 70 years, that made mathematical sense to not pay off your mortgage early, because the interest you paid was offset by three massive forces. 1. Tax deductions. You could deduct thousands in interest payments annually. That was real money coming back to you every year. 2. Inflation eroding the actual value of your debt. If you borrowed $200,000 in 1985 at 10%, that seemed terrifying, but inflation averaged 3% a year. The actual value of what you owed was shrinking in real terms while you paid it down. Your debt was getting cheaper. 3. Investment returns that exceeded your mortgage rate by a huge margin. In the 1980s and 1990s, the stock market was returning 12, 15, sometimes 18% annually. Your mortgage was 7 or 8%. The spread was so wide it was almost reckless to not invest the difference. So the entire financial ecosystem was aligned. Your government subsidized borrowing. Inflation punished savers and rewarded borrowers. Investment markets returned more than your mortgage cost. Everything pointed in one direction: keep your mortgage, invest the difference, and build serious wealth. Then something happened, gradually, quietly, without anybody making an announcement. The system changed, interest rates collapsed, inflation disappeared, tax deductions became less valuable as rates dropped, but the cultural narrative didn't update. We kept telling the same story. Pay off your mortgage, become debt-free. This is the path to financial security, except the math changed, and most people didn't notice. Because admitting this means questioning something fundamental about how they've structured their financial life. Let me give you actual numbers. Let's say you have a $350,000 mortgage. Interest rate is 4%, 30-year term. Your monthly payment is roughly $1,670. That's your starting point. Now let's say you've got an extra $200 a month burning in your pocket. Maybe you got a raise, maybe you cut some discretionary spending. You have $200. And it's burning in your pocket because everyone, your parents, your friends, Dave Ramsey, your Aunt Carol, everyone is telling you to throw it at your mortgage. What should you do with it? Option A, put it toward your mortgage, pay it off faster, become mortgage-free sooner. Option B, invest it instead, keep the mortgage, let compound interest do its work in the market. Everyone's first instinct is option A. It feels right. You're literally eliminating debt. Psychologically, it's powerful, it's tangible, it's visible. You can see your mortgage balance dropping every single month. Let's run the actual math, both directions. If you put that extra $200 toward your mortgage on a 4% loan, you'd pay off your house roughly 5 years earlier. You'd be mortgage-free by age 60 instead of age 65. That feels like a massive win. You'd save approximately $120,000 in total interest payments over the life of the loan. That's real money, that's a car, that's a kid's college tuition. That's significant, so option A is clearly better, right? Not quite. Now let's look at option B. You invest that same $200 a month instead, in a simple index fund, nothing fancy, the S&P 500. Historically, the stock market returns about 10% annually on average, not 10% guaranteed every year. Some years it's negative. But 10% is the long-term average over any 30-year period in American history. After 30 years, you don't have a paid-off house. You have a $350,000 mortgage you still owe. But you also have $301,000 sitting in investments. Let's do the full accounting. You paid roughly $720,000 in total mortgage payments over 30 years. But you made $301,000 investing. Your net cost for housing is actually $419,000. Compare that to option A, you paid off your house in 25 years. Total cost for housing, $500,000. Then you had 5 years left, nothing happening. The house is paid off, you're just living there, you own it. Congratulations. Option B just saved you $81,000 in real money. Not percentage points, not abstract concepts. Real dollars you can touch, real dollars that represent your future, and that's the uncomfortable truth nobody wants to admit. Paying off your mortgage early doesn't make you financially stronger. It makes you financially weaker. It locks up capital that could be working for you. It creates an opportunity cost so large that over decades it compounds into serious, measurable wealth destruction. But wait, there's more. Because this example is actually generous to the pay-it-off early crowd, it assumes you stop investing after 30 years. In real life, the person with the paid-off mortgage stops there. They own a house, the person with the mortgage and investments. They keep investing for 10 more years, 20 more years for the rest of their life. That $301,000 at year 30. If they keep investing the same $200 a month, by year 45, that's almost $900,000. By retirement, they've built wealth that dwarfs the value of the house itself. The person who paid off their mortgage, they own a house worth maybe $700,000. Good, impressive, but they own nothing else. One person has a house plus a portfolio. One person has a house. And somehow we celebrate the second person's financial discipline. The problem isn't just lost investment returns. There's something deeper. It's what paying off your mortgage does to your financial flexibility, your optionality, your capacity to make decisions when the world throws curveballs. Let's go back to our person with $200 extra a month. Let's say they're conscientious. They're not reckless. They're disciplined. They understand delayed gratification. They decide that paying off their mortgage early is the right thing to do. They commit. They make extra payments every month. For 25 years, they're focused on one goal: eliminate that debt. And they succeed. At age 60, they own their home free and clear. No monthly payment, no lender, no obligation. It feels like freedom. Then something happens. Life happens. They lose their job. Maybe they're 62. The economy shifts. Their industry consolidates. Their company downsizes. They've got 6 months of emergency savings, which is actually more than most Americans, but they're still vulnerable. Or maybe it's not a job loss. It's a medical emergency. Their spouse needs treatment that insurance doesn't cover. Their adult child faces a crisis. A parent needs long-term care. Suddenly they need capital, not a little, a lot. If they'd kept that mortgage, they have options. They can refinance. They can take a home equity line of credit against the equity they've built. Even with a slightly imperfect credit score, banks will lend to them secured against a home. The interest rates will be manageable, maybe 8% instead of 4%, but they can get money. But our person who paid off their mortgage, they own their home free and clear. That sounds like security. It isn't, it's a liquidity. It's capital trapped in an asset that can't easily be converted to cash without either selling the house or taking out a new mortgage anyway. And if their credit score took a hit from job loss, even that option is expensive. They're locked in. Here's where it gets really interesting. The person with the paid-off mortgage is actually worse off than the person who never accelerated their payments, because the accelerated payoff person has paid off their house. But the person who invested the difference, they have $300,000 sitting in liquid investments. That money is accessible. That money is working. That money is a financial cushion. They can tap it if they need to, or they don't. Either way, they have optionality. They have flexibility. They have the ability to make choices based on what actually happens in their life, rather than based on a plan they made 30 years earlier. This is why wealthy people almost never pay off mortgages. And I'm not talking about billionaires in Manhattan or tech founders. I'm talking about actual financially successful people. The accountants, the doctors, the business owners, the people who understand how money actually flows through an economy, they get 30-year mortgages at the lowest rates they can negotiate. Sometimes they get 40-year mortgages or home equity lines of credit. They make the minimum payments. They invest every dollar they don't absolutely need to pay. And when they pass wealth to their children, their kids don't inherit a paid-off house and a small savings account. They inherit both the house and a portfolio that's worth more than the house. The wealth transfer is completely different. The person who paid off their mortgage early, they leave behind a paid-off house and maybe a modest retirement account. It's worth something. It's respectable, but it's not generational wealth. It's not the kind of foundation that sets the next generation up to skip a rung on the ladder. Now, before you dismiss all this as cold numbers divorced from real life, disconnected from how humans actually experience security and peace of mind, let's talk about why this resonates so powerfully with people. There's something psychologically real about owning your home outright, about having no debt, about that final mortgage payment. It feels like freedom, and that feeling isn't irrational or stupid. It is a form of freedom, just not the form of freedom that actually improves your life financially. This is the trap. The emotional narrative is so compelling that it overrides the math. You feel freer with a paid-off mortgage. You sleep better at night. You worry less. You can look people in the eye and say, "I own my home." There's dignity in that. And that dignity, that psychological safety, that peace of mind, it's worth something real. It genuinely is. But for most people, that psychological benefit costs them hundreds of thousands of dollars in wealth destruction over their lifetime. It's a trade, a choice. And they're making it without even knowing it's a choice. Here's what makes this worse. The financial industry benefits from this cultural narrative, not because they're evil conspirators, but because they make money either way. If you keep a mortgage and invest the difference, you're paying them investment management fees, expense ratios, advisory fees, trading commissions. That's where they make money. They want your investments. But if you pay off your mortgage early, you might not invest anything. You might just sit on cash. And that's fine for you, but it's not great for the investment industry. So who's benefiting from the pay off your mortgage narrative? The real estate industry, the mortgage originators. The people who make money when you're focused on becoming debt-free rather than on wealth building. They benefit from this story, and they've got massive marketing budgets. They've got cultural credibility. They've shaped the conversation for decades. Everyone wins except you and your financial future. And nobody's incentivized to tell you the truth, because the truth requires you to be disciplined in a different way. Not disciplined about paying off debt, but disciplined about investing. And investing is harder to market, it's harder to visualize. It doesn't give you that same visceral satisfaction of watching a balance drop to zero. Now, I need to say this clearly because this is where people usually misunderstand and think I'm telling everyone to ignore their mortgages. This advice only works if you actually invest the difference. That's the real requirement, not just theory in practice. If you pay off your mortgage early because you're the type of person who would otherwise spend that $200 on takeout and streaming subscriptions and vacation flights and lifestyle inflation, then paying off your mortgage might actually be the right call. Not for mathematical reasons, for behavioral ones. If the only way you'll accumulate wealth is by forcing it through your mortgage payment, then do that. The math works against you, but at least you're not starting from zero. There are also legitimate reasons to accelerate mortgage payments that have nothing to do with pure finance. If you're terrified of debt, genuinely anxious about it, and that terror prevents you from making good decisions elsewhere, then psychological safety matters more than optimization. Sleep better. Live better, pay off the mortgage. If you're approaching retirement and you want to eliminate monthly obligations so your pension and Social Security cover your lifestyle, that's a real consideration. Predictable cash flow matters in retirement. If interest rates spike to 9% and you want to lock in lower rates through refinancing, and you want to eliminate a variable rate component, that's tactical and legitimate. But stripped of all those complications, stripped of psychology and behavior and legitimate life circumstances, the pure math is this: carrying a low-interest mortgage while investing the difference builds more wealth than paying off the mortgage early. Period. Full stop. That's what the math says. And we've inverted it in our culture. We took the right answer and made it wrong through repetition and cultural reinforcement and financial industry incentives. So here's the question I want to leave you with as you close this video. If paying off your mortgage early actually makes you weaker, not stronger, what else have you been told about money that's backwards? What else are you optimizing for that's actually making your financial life worse? Because the system doesn't care about your intuition. It only cares about the math, and the math never lies.